In this video, we will understand how to do the common size analysis of the financial statement of any company. Now, what do you mean by common size analysis? What are we supposed to prepare in common size analysis? We will have to prepare common size income statement and common size balance sheet. So let's start. Profit and loss account is given in the problem along with the balance sheet, right? So now we'll have to find out which item goes under which heading. So opening stock, if we talk about profit and loss account, we will have to convert this into vertical common size statement. So opening stock will go in COGS, cost of goods sold. So we'll write here cost of goods sold. Purchases will again go under cost of goods sold. Office expense will go under operating expense. Selling expense will again go under operating expense. Depreciation on asset let out, this will go under non-operating expense because this is the asset which you have let out. So this is not operational in nature, this is not your operating expense, hence we are taking under the head non-operating expense. Provision from tax will be subtracted from PBT, profit before tax. Okay, and then if you talk about credit side, sales is the first item in the vertical income statement. Closing stock will go under COGS. Income from asset let out is your non-operating income. If you talk about balance sheet, share capital will go under shareholders fund. Reserves and surplus, shareholders fund. Creditors, current liability. Bank overdraft, current liability. Provision for taxation, current liability. On the asset side, we have cash, current asset. Debtors, current asset. Stock, current asset. Let out asset, this will go under fixed asset. Although you have let out, you have given your asset on rent, but it will be considered as your fixed asset. So let's start. So the first item under income statement, vertical income statement, we take sales, which is 5,000. So we will prepare common size income statement in vertical form. In this, the first item that we are taking is sales, 5,000. Then we'll go back to the question. There are 1, 2, 3 COGS. First is opening stock 200, second is purchase 4,000, third is closing stock 200. Now this closing stock will be subtracted in COGS. So you can see the solution. Under cost of goods sold, we have taken opening stock 200, purchase 4,000. So total comes to 4,200, and then we have subtracted closing stock 200 from this total of 4,200. So finally we got 4,000. Now what is this 4,000? This is our cost of goods sold. Now this cost of goods sold we subtract from 5,000, which is sales. So we get gross profit. So our gross profit is 1,000. Now from this gross profit we subtract operating expenses. So let us go back to the question. There are two OE, operating expense. The first one is office expense 80 and second one is selling expense 160. So let us record office expense 80, selling expense 160 under operating expense. And if you take the total of these two, you will get 240. Now what is this 240? 240 is your operating expense. Now this operating expense will be subtracted from gross profit. You will get operating profit. So our operating profit is 760. Now to this operating profit, we add non-operating income. So if you see the problem, you will find non-operating income over here in the credit side. Income from asset let out 640. So let us go and add this non-operating income to the operating profit. So you will get 1400. Now from this 1400 you will have to subtract non-operating expense. So we have one non-operating expense over here in the problem, that is depreciation on asset let out 400. So this depreciation on asset let out will be subtracted from this 1400. You will get 1000. Now what is this 1000? This is our profit before tax, 1000. Right? Now from this profit before tax, we will have to subtract provision for taxation. So if you see the problem, provision for tax 320 is given in the question. This provision for tax will be subtracted from profit before tax. So finally you will get profit after tax, which is 680. Right? Now let us try to understand how to do this common size analysis. So in this case, you will have to take some base, and here in the income statement, common size income statement, we take sales as our base. So anything if you take base will be assumed as 100%. Hence, if you see 5000, we have assumed as 100%. All right. Now, based on this, you will have to calculate the percentage of each and every item. Taking sales as a base, that means 100%, you will have to calculate the percentage of each and every item of this common size income statement. For an example, if we talk about opening stock, now opening stock is 200, right? Now if I want to know the percentage of opening stock, taking sales as a base, how to do that, how to calculate that? So what I'm going to do, I will take 200 into 100 divided by 5000, right? So 200 into 100 divided by 5000 will give you the percentage of opening stock. So we got 4%. That means we can say opening stock is 4% of the net sales. Same way, purchase. How to calculate the percentage of purchase? 4000 into 100 divided by 5000. You will get 80%. Now here we can say that our total purchase is 80% of the net sales. Okay. Then if you talk about closing stock is 200. So again you will get 4%. So here we can analyze that closing stock is 4% of net sales. This is how we will have to do common size analysis. And right now we are doing the analysis of income statement, common size analysis of income statement. Okay. So our cost of goods sold is 4000. Now again, if you calculate the percentage, 4000 into 100 divided by 5000, you will get 80%. So we can say that cost of goods sold is 80% of net sales. Okay, and if you talk about gross profit is 1000. Calculate percentage. 1000 into 100 divided by 5000 will give you 20%. So your gross profit is 20% of net sales. Same way you will have to calculate percentage for each and every item. Office expense is 1.60%, selling expense is 3.20%, total operating expense is 4.80% of net sales, and that is how we are getting operating profit of 15.20 of net sales. Okay, now here you can see as your cost of goods sold is 80%, your gross profit is coming to 20%. And because of this operating expense, again, your profit is reducing. So you can see your profit is reducing to 15.20%, your operating profit. Now to this operating profit, what we are doing, we are adding income 640, which is 12.80%. 12.80%. So that is how your now you see your profit is increasing. Earlier it was 15.20. As you added the income to the profit, your profit went up to 28%. Okay, so now we can say that profit till non-operating income is 28%. Now from this 28%, You have subtracted non-operating expense. Calculate the percentage of non-operating expense. It is 8%. So 28% minus 8%, your profit before tax is 20%. Again reduced. Now, why this profit is reduced? Profit before tax because of non-operating expense. Because non-operating expense is 8% of the net sales. So we at this moment we can say that our profit before tax is 20% of net sales. So once you subtract the provision for taxation, you will get profit after tax, which is 13.60%. Right? So finally, we can conclude that profit after tax net sales. Right? So what we can say, if you sell a good of if you sell a goods of worth rupees 100, you will get a profit of rupees 13.60. This is what you can analyze. Next year, suppose if you are going to sell your product worth rupees 1000, okay, so profit will be 130, 1360, 13.60% of that. So with the help of this, we can do the analysis that next year if we do the sales of this much amount, so we will be able to get the profit at this much percent. Right? Now, if you feel that the profit is less, or you're not able to meet, or you're not able to satisfy the stakeholders or the shareholders because the profit is low, so in this case, you will have to reduce, or you will have to control your cost. The moment you control your cost, your profit will go up and you will be able to satisfy the shareholders or the investor of the organization. Right? Now we'll have to go to the balance sheet. This is how we prepare common size balance sheet. You will have particular 2 rupees column and 2 percentage column. Why we have 2 rupees and 2 percentage? Because one is inner and second is outer column. Now in common size balance sheet, you can see we have share capital and reserves and surplus. Share capital is 800, reserves and surplus is 1392. So let us record this. Share capital is 800. We have converted into 1000. It is 8 lakh. Reserves and surplus 13 lakh 92,000. So total sources of fund is 21 lakh 92,000. Now fixed asset under application of fund. As you know, we have 32 lakhs of fixed let out. We have let out our asset of 32 lakhs and accumulated depreciation of 12 lakhs. So we can go back and check question. Yes. So you can see fixed asset 3200, which is converted into thousands. Okay. So that is how you will get total fixed asset, which is 20 lakhs. Working capital. Under working capital, we take current asset, cash 40,000, data 8 lakhs, stock 2 lakhs. Right? So we got total current asset as 10 lakh 40,000. From this, we will have to subtract current liability. So under current liability, we have taken creditor, provision for tax, and bank overdraft. So total current liability is 8 lakh 48,000. So current asset, that is 10 lakh 40,000 minus current liability, which is 8 lakh 48,000, will give you working capital of 1 lakh 92,000. So on the asset side, this 20 lakhs of your fixed asset and working capital 1,92,000, you will have to add both, then you will get total application of fund. Now this total application of fund should be equal to the total sources of fund. Now under total sources of fund, we do not have old fund, that is borrowed fund. Okay, so our total sources of fund and total application of fund is tally. Now let us try to calculate the percentage. Now here again, as we have taken under income statement, as we have taken net sales as the base. In the balance sheet also, we will have to take some base, and taking that as a base, we will have to calculate the percentage for each and every item. Right? So under balance sheet, we take either total sources of fund as base, this one, or you can say total application of total sources of fund or total application of fund as a base. So let us take, now here we have taken total sources of fund as a base, which is 100. Now we will have to calculate the percentage of share capital. Let's say if we talk about share capital, how we will calculate the percentage of share capital? So if I want to know share capital is how much percent of the total sources of fund, that means if you have calculated, if you have collected 21,92,000, so these are the total sources of fund that you have collected from various sources. So in this we can see we have only two different sources. One is share capital, second is reserves and surplus. And if I wanted to know that what is the percentage of share capital, okay, so we will calculate in this way: 8 lakhs okay, 8 lakhs into 100 divide by your base. Base is 21,92,000, right? So once you calculate this, you will get the percentage. So you can calculate on your own. If you do this calculation, you will get sorry 36 lakh 50,000. So we can say share capital is 36.50% of the total sources of fund, like this. Okay. Same way, let us calculate the percentage of reserves and surplus. So let's see, 13,92,000 into 100 divided by 21,92,000. So we will get 63.50. So if I want to know the breakup of the total sources of fund which I have collected, this is how we can find out in terms of percentage, because percentage is always helpful in analyzing the things. That is why if you get marks also, you never compare your marks with your friends. You always compare the percentage. Like how much percent you got, he will say 60%. Then he will ask you how much percent you got, you will say 62%. So then you will analyze 62% is better than 60%. So percentage is always better to analyze things. So here also we can say that out of total sources of fund which we have collected, 36.50% we got it from the shareholders, and remaining 63.50% we are having our own reserves and surplus. So that is how we have collected this fund, right? Now, if you talk about application of fund, in here under application of fund, you will have to take total application of fund as the base. Here, 100%. Now, based on this, you will have to calculate the percentage of each and every item which comes under the application of fund. So let us start. So if you talk about 32 lakhs, so we will calculate 32 lakhs into 100 divided by the base, which is 21 lakh 92,000. So it's actually this one only. You can see, you can compare here. 32 lakh into 100 divided by 21 lakh 92,000. You will get 145.98%. Right? Same way, let us calculate the percentage of accumulated depreciation. 12 lakh into 100 divided by 21 lakh 92,000. You will get 54.74%. Let us calculate for 20 lakhs. 20 lakhs into 100 divided by 21 lakh 92,000. You will get 91.24%. Right? Let us calculate for 40,000. 40,000 into 100 divided by 21 lakh 92,000. You will get 1.82%. Okay. Let us calculate for 8 lakhs. 8 lakhs into 100 divided by 21 lakh 92,000. You will get 36 lakh, sorry, 36.50%. Let us calculate the percentage of stock. 2 lakh into 100 divided by 21 lakh 92,000. We will get 9.12%. Let us calculate the percentage of total current asset. So it will be 10 lakh 40,000 into 100 divided by 21 lakh 92,000. You will get 47.44%. Current creditors. 6 lakh 40,000 into 100 divided by 21 lakh 92,000, we will get 29.20%. Let us know the percentage of provision for taxation. 8,000 into 100 divided by 21 lakh 92,000 will give you 0.36%. Let us know the percentage of bank overdraft. 2 lakhs into 100 divided by 21 lakh 92,000, you will get 9.12%. Percentage of total current liability. 8 lakh 48,000 into 100 divided by 21 lakh 92,000, we will get 38.68%. Now let us know the percentage of working capital. 1 lakh 92,000 into 100 divided by 21 lakh 92,000, you will get 8.67%. So now we can say that whatever fund we have employed, out of those, 8.76% is towards working capital, right? And then we have 9.24% towards fixed asset. So your majority of fund you have employed on fixed asset, because you can see 91.24% you have employed or you have used for buying an asset, right? So this is what, or this is how the common size analysis is done. So I hope you have understood how to do the common size analysis, means how to prepare the common size income statement and common size balance sheet. Thank you for watching this video.